This is Satya Pradhiman of Cirrus Research. The latest monthly market review is just out, the briefing. The title, AI and Everything Else, June's two-track market. What we've observed in June could be really a synopsis for the last year. We've seen a fairly diverse market where we're seriously AI-centric, and yet the market globally continues to broaden. We've also underscored that our value growth oscillators now in the last couple of months overweight value. What's interesting is the value versus large cap growth strategies. In that comparison for the last year, value is sharply outperforming growth. And this is shocking considering how AI centric all investors have become. One of the key indicators underneath that style oscillator is the relative valuation of growth stocks to value stocks. And what you'll notice in this chart is that we've done the valuation comps going back to the 90s for both large and small caps. What is very important is to notice the large cap comparison. We're now hitting about 3 standard deviations above normal on how large growth is priced relative to the market / value stocks. If we repeat that analysis for the small cap growth to value oscillator, that number is sort of slightly above long-term averages. The bottom line is that what we have seen is that not only has value outperformed growth in both large and small caps, however, it is just negligible in the small cap area. I believe this sort of valuation extreme seeing in mega caps for growth stocks is really what's underneath this sort of fundamental rotation. If we look at the month of June as an example, what you'll notice is that several of the value factors have sharply outperformed. And in fact, when we look at trending factors, factors like earnings or expectations were actually down, and yet relative strength had outperformed, but the spreads were nowhere as noticeable. So bottom line, when we look at sectors in the month of June, even though we had a massive AI run in some of the key subcomponents, notice that the technology sector as a whole was marginal. And that's because of how fragmented this AI trade is becoming, where it's benefiting potentially industrials more right now than in the technology sector. Month is a classic textbook case of what's going on. In terms of the broadening argument, take a look at what was second, third, and fourth best performing sectors in large cap camp: healthcare, financials, real estate. If you look at the skew for the smaller cap arena, it's not terribly different. So yes, markets are broadening. Very important, we're finally starting to see some active management traits within software. What we've noticed in this last year was really a breakdown of all software effectively index selling. We've shown in prior research that the dispersion of returns are starting to pick up or widen. This is good. It means people are now treating the sector not as a whole, but as individual businesses. I think the CrowdStrike versus Salesforce performance comp since May is striking. This is potentially what's going on now in the software segment, that yes, there are firms like Salesforce that might remain a risk and continue to be disrupted by AI tools. And at the same time, there are firms like CrowdStrike, which are likely to benefit as AI tools begin to roll out. Take a look at the full report, and as always, happy to take your questions. Thank you.